Welcome back to the Warlords of Wall Street. Well, the big headline as far as we were concerned today is that the news reports that the Tesla price cuts are affecting their margins, which is something that they actually discussed with the market and pre-released weeks ago. But when the news story hits the desk, then the talking heads get all excited. It turns out that their margins, which were exceptional, before they cut their prices in China, they were up around a 22% profit margin on making a car. And to put that into perspective, Ford and General Motors and most of everyone else in the manufacturing industry of automobiles works on a 16% or less profit margin. And so for them to be still at 18%, which is where Tesla finds itself today, 18 to 19 and change, still very nice, still dominating based on recent reports from J.D. Power and a number of other independent sources that Tesla still is somewhere around 70% of all of the electric vehicles sold in America. Over 60% were actually Teslas, and that worldwide, that number is holding pretty steady as well. So, unfortunately, we saw some give back in our Tesla position, but we're holding that for a return to the $300 range, and that's just something that we've spoken to on a number of occasions. Moving on to what we're seeing in the 2 and 10-year government bond range, this is a tell, and it allows us to take a look at, if you're looking through just the interest rates and the behavior of the 2 and 10-year bonds, the government securities, the fact that the yields are coming down a little bit, and that you've got central banks all around the world, Australia, New Zealand, and a couple of others just today, are pausing their rate increases. So then you take a look at what the U.S. government bonds are doing, and for a while now, with these rates pulling back, they were essentially signaling that Powell has run out of runway here, that there might be another 0.25% bump, maybe next month or thereabouts, when he gets the fresh inflation information that should be available to him in days coming. But the 2 and the 10-year tells me, based on its activity, that we are at an end of the rate increases. Now, whether there's another 0.25 point to be bumped in there, I don't know. I would concede perhaps there is. But at this juncture, I really do think that our prognostications that we should see the first rate cut in the last quarter are becoming more and more likely. I like what I'm seeing. I think that the jobs reports and the job openings reports, something that Powell actually refers to often, and that is a point that's being made on television as early as today, is that those numbers are going in the right direction. And that's another reason why Powell can start to feel like he can take his foot off the accelerator. So I like what I'm seeing. The jobs, even though the openings are dropping a little bit, they're still very healthy, and you're just going to find it difficult to shove an economy that's as strong as this one is around all the fringes, and with a job market that needs more bodies than apparently are available. Really hard to tip something into a serious recession when these factors are present. Usually they're not. Especially with the job market. Now, inflation will tend to be a little stickier because people have purchasing power. And the reality is that the vendors and merchants and service providers out there have been successful in raising their prices. And people are still buying they're buying their Kraft macaroni and cheese, even though the cost went up. We've talked about this before. So inflation is going to be a little trickier coming down, and that's okay. I'm all right with inflation coming down a little slowly, so long as we don't go a little too hard and tip everything into chaos. So I think the market has been doing a lot of Powell's work for him, and that too is pleasing because it means that we'll see a little more stability in the market. We're right on the edge of earnings seasons now too, so everybody is going to start coming forward. And once again, this is something that we continue to beat the drum about. You're going to see that the numbers aren't as bad as people were saying. There's been an awful lot of bears because the doom and gloom guys love to jump on the TV and tell you the sky is falling. Well, the sky is not falling. There are going to be a couple of sectors that don't do as well as others, but that's always the case. There's always going to be somebody, one section, one type of business or another, that just isn't enjoying all the positive headlines. Like right now, the banks had a pretty good run. Now everybody's poo-poo about the banks. Well, the banks will work itself out because there is a lot involved in making a bank unstable, and those particular issues are just not present. The real problem that the banks have is that their bond portfolios are underwater. That is an unrealized loss. All right? They're not going to be going out and selling these bonds at a loss. They're just going to keep them on the books. And when they come to maturity, they're going to cash them in. And that what became a problem today isn't a problem tomorrow. They're going to go ahead and they're going to continue to invest and barbell the loans that they're making now with new purchases that are in the 3s and the 4s. So this is a problem that doesn't exist anymore. It was only then, and it will work itself out. So everybody needs to relax about this systemic threat that the regional banks have to the banking industry. And even Jamie Dimon is out there, God bless his soul, banging the drums that there's a crisis coming. Well, between his economic hurricanes and everything else, Jamie hasn't been right on a lot of stuff. And he's a smart guy, don't get me wrong. Smart guy at the helm of one of the most powerful financial institutions the earth has ever seen. But Jamie hasn't been right, and he's not going to be right about this. But what Jamie is doing by thumping this drum is he knows that people listen to him. And there are people that are doing business with banks that aren't quite as big as his, and people that aren't doing business with him or not enough. And this siren call that he's making to the industry will probably attract assets to him. He will get some loan business out of it. And from that respect, it's hard to argue. Why wouldn't you say this if you were in his position? It's smart for business, for his bank at least, and maybe a couple of the other super big guys. So something else to keep in mind, I just happened to have heard it when I was shopping the other day. I literally, and when you get the little guy in the street talking about this stuff, it really pleases my heart. But I was overhearing a couple of people talking about how much money, their taxes are all going to support the banks and all the bank failures. And that's all I need is more of my money going in to support these rich bankers. Well, the truth is that isn't what's happening. The FDIC, the insuring body behind banks, is not a government agency. It's not funded with your tax dollars. It is funded and maintains its stability through fees that it charges its member banks. And it is the bank's own money that is being used to prop these things up. The FDIC is a business entity unto its own, and it's private and privately owned by the banks themselves. So relax about your tax dollars. Stop talking about that over dinner time, that the banks are going to go ahead and take all your tax dollars. It's not being used, not a penny of that for their rescue. And they're not being rescued. You've got a couple of 3 out there that had some real problems, made the press, and now all of a sudden, you're not hearing about them anymore. The fire is out. It's done. Somebody stepped in, they bought their assets, it's all over. So relax about the banks. You heard that here first. They will work themselves out, and frankly, I would be a buyer of the Regional Bank Fund, KRE, and a couple of others like that. Sit on them for a couple years, and you're going to be richly rewarded because they got nowhere to go but up. And banks just don't go out of business. They just really don't. Every once in a while, something will grab the headlines like SVB did, and then it undermines the confidence in the market. I will concede that, because banks are considered, and always have been, a very stable foundational stone in the market and in the economy. So when trouble brews somewhere, that makes everybody nervous, as well it should. However, I think it is quite limited, the issues. It may have been a shot across the bow for everybody to start looking at banks' books a little better, maybe tighten up regulation, which there is nothing wrong with, and to make sure that you run the cowboys out of the business that are running banks like it's a slot machine and taking big bets and what have you. They have no business being in banking, because that's not what it's for. If you got a bank CEO and a board of directors that has no problems taking huge leverage bets and a heavily aggressive lending policy, no. That guy needs to walk across the street and go to work for the investment banking firm and take his chances, if that's what he's looking for, is excitement. So anyway, the big news with the central bank starting to pause, I think that's a great signal that ours will soon pause their rate increases, and I think that ends up boding very well for our opportunities coming as the earnings season is upon us. And as I was starting to say, with the earnings, they're not going to be as bad as people thought. But the tail that always wags the dog when people are nervous, and people are nervous right now, is that what is that forward guidance looking like? Well, that forward guidance is going to be very important, and I think people, rightly so, will end up being conservative with the guidance of what the next couple of quarters will bring. But the light is at the end of the tunnel. There is no doubt. I have about rates beginning to be not only paused, but they'll start rescinding. They'll probably pull down a quarter of a point, maybe a half, by the end of the year. I'd love to see that, and that's when it really gets good in the market. So you're going to want to take a couple of minutes right here, right now, and you're going to want to go look for the very best quality pieces out there that have been beat up for some reason. Some of the, not necessarily the biotechs, but you've got the Johnson & Johnsons and a few others of the world that haven't been treated right. You've got some of the banks that are out there. Consumer durables, I don't know. I might be a little wary of that, but what we'll end up doing is we'll put our shopping list up over the next week or so, and we will tell you, as we also promised, that we would put a couple side by side in the charts and show you our exact analysis process and how we arrive at which one we buy as opposed to the other. And then we'll end up telling you, here's what we're keeping an eye on. And that the moment that we start to move forward and we start buying again, because we have a lot of cash in the portfolio, more than half is in cash, trying to be conservative right now. But when we start moving forward, you'll be the first to know. You'll just have to follow us a little closer, and you'll end up being able to track our picks to see if how smart we think we are over here. Well, that's all that we have to say today. Keep your powder dry. Take your profits where you can. Don't be greedy. Take those profits. Have a good day.